Welcome everyone, happy Thursday. Hope you're all doing well. Thank you so much for taking the time to join today's webinar. We're going to be talking about rentals and rehabs. Actually, my colleague Alex and I are doing the webinar today. He may be joining late. He has some technical difficulties with weather. So we're going to go ahead and get started. My name is Reneika Lightbourne. I'm one of the business development specialists here at Advanta. I've been with Advanta as an employee for a little over two and a half years now, but I'm also a client of Advanta where I self-direct my account as well. If you have any questions or need further assistance, want to do a deeper dive, definitely feel free to give us a call or send us an email. If you have questions, feel free to type those in the question box and we'll get those answered for you throughout. So just a little housekeeping. At Advanta, we don't give any tax, legal, or investment advice. We also don't endorse any particular products. Just know all of the information that's presented today is just more so educational purposes. So we always encourage you to do your due diligence, confer with your professional team. So whether it's your CPA or your accountant or your financial advisors. So just a little history about Advanta and who we are. We've been in the business for nearly 20 years as one of the leading self-directed IRA administrators in the industry. Our headquarters is located in Largo, Florida, which is the general Tampa Bay area. But Advanta also has an office here in Atlanta, which is where I'm located. We do have clients nationwide as we have nearly $2 billion under our administration. Just know that any IRA account with us, just sitting in cash, it is FDIC insured. But also too, in terms of separating ourselves from our competitors, we provide you that concierge style service, that one-on-one, a dedicated account manager. And then of course, our educational content, which includes having recurring webinars, having guest speakers and so forth. Okay, so I'm going ahead to allow Alex to also participate. So you should.
Here we go. Can you hear me, Reneika?
I sure can.
All right, 1 second. Just, I think you might need to give me mouse control as well. Okay, now try to advance the slides, Reneika. Do it again. All right, great. I think we're on the same page now. Sorry about that, everyone. Okay, so let's get right back into it. Please remember to type in any questions that you have to the chat box. We will certainly take care of those for you. So a few key takeaway points that we'd like everyone to have for today is renting and rehabbing homes can both be accomplished by IRAs. You don't necessarily have to pick one versus the other for doing your particular strategy with your IRA. Both work, they have their ups, they have their downs. We're going to go through those for you today. So just be aware of that. The key differences between cash flow rentals and flips, because there are quite a few differences between the two, maybe understanding the benefits of one versus the other, and how to correctly use an IRA to rent and flip homes. We want to go through the procedural aspect and kind of give you an idea of what it looks like from the identification of a property to opening an IRA, and then actually getting through the nuts and bolts of actually what that means to invest in real estate, whether it's a rehab or a flip with your particular retirement account. Now, if you haven't heard of self-directed IRAs, don't be alarmed. You're definitely not in the majority of people. Only about 4% of the entirety of the retirement plans in the United States are actually held in a self-directed manner. There's a little bit more than $30 trillion worth of IRA, or I should say retirement plan investments in the United States. So it's a very large number, a very large basis of investing, and not a whole lot of it is self-directed. So that's why a lot of people haven't heard about it. It's just the vast majority of people don't realize that the IRS regulations really allow for you to invest in almost anything that you'd like, so long as that it's not a collectible and it's not a life insurance policy. So whatever you've identified, falls outside of those two categories, then really it's almost a kind of a green light to go ahead and invest that. There are some nuances to that, but just understand if you haven't heard of self-direction, that might be the reason why. And, what exactly is the self-directed IRA? It's an IRA that gives the owner complete control over their retirement funds and their investing decisions. So while some bigger companies and brokerage houses may say that you're self-directing, in reality, they're just kind of talking about being able to invest into whatever security you'd like. In reality, self-direction, from the perspective that we're coming at it with, is the full breadth of alternatives. Being able to invest in things like real estate, mortgages, and notes, it's private placements, meaning private stock and things like that, precious metals, foreign currencies, futures trading, and really a whole lot more than that. But what we're going to be focusing on today really is the real estate aspect of that, because as Reneika alluded to, we administer about $2 billion worth of assets for our clients, and a solid about half to maybe slightly more of that is real estate related. So it's things like people buying a single family rental home, it's people buying a duplex, it's people getting together in some type of LLC or trust to do a larger project, or maybe some type of apartment syndication. So just understand that, the self-directed IRA in this context is kind of what we're going to be focusing on here today. And I'll turn it back over to Reneika for the next few slides.
Thank you, Alex. So when it comes to the different types of accounts that can be self-directed, it's the account types that you're already familiar with. Again, the term self-directed just means you choose the investment that works for you. But for individuals, you have traditional IRA, which is tax deferred, meaning you get the tax deductions now and you pay taxes later when you take it out at retirement at 59 and a half. And with a Roth account, you elect to pay taxes up front, grow your retirement account, and then of course at retirement when you take that distribution is tax-free. If you are self-employed or have a side business, you can certainly look to self-direct a solo, a SEP IRA, a simple IRA, or solo 401k. I know a lot of real estate investors specifically like the solo 401k because you have a lot more flexibility, some higher contribution limits that we'll take a look at shortly. And then, of course, with Advanta's solo 401k, we do have a Roth component, and that tends to be very attractive to our clients. You can certainly look to self-direct a smaller account like an ESA for your child or grandchild, the HSA, which covers medical-related expenses. For an HSA, you do have, it's based on having a high deductible plan, so you want to make sure you have a high deductible coverage. And then, of course, any former employer plan like an old 401k or 403b or TSP type plan can be self-directed. The only thing to keep in mind is if you have a current employer plan and you're not yet 59 and a half, most times that plan administrator will stop you or prevent you from moving those funds. So you want to check with them to see if they will allow you to do an in-service transfer or rollover if they have that special exception. But the key thing here is just knowing that the contribution limits vary, and then of course with a Roth, the distribution is tax-free at retirement. In terms of the annual contribution limits, so each year the IRS allow you to make a contribution to your retirement account. Obviously, you want to have earned income. With a traditional IRA or Roth IRA, you can contribute up to $6,000 if you're under the age of 50. It's $7,000 if you're over 50. With a SEP, as the employer, you can contribute up to 25% of your employee's compensation, not to exceed $58,000. And then with a simple IRA, you as the employee can put in $13,500 with an additional $3,000 catch-up, and then the employer can match up to 3% of your earned income. Again, with the solo 401k, you have higher contribution limits where you can possibly put up to $58,000 or $64,500 if you're over the age of 50. For the ESAs, educational savings accounts, you can put in $2,000 per year per child. And then with an HSA, depending on the type of HSA account that you have, for individuals, you can put in $3,600 a year or $7,200 for a family plan. And you have the additional $1,000 catch-up if you're over the age of 55. If you have multiple accounts, you can elect to certainly partner your accounts together to do deals. In addition to making an annual contribution, you can fund your account by doing a direct rollover or a transfer from an existing IRA. A direct rollover comes into play if you have a former employer plan, like an old 401k or 403b. You would actually have to initiate that request, meaning reaching out to that former employer plan, letting them know that you want to move the funds over into another qualified retirement account over with us at Advanta. And of course, they would send a check directly to us to be deposited into your account. If you have an existing IRA, part of the process is obviously you're going to fill out the appropriate paperwork with us, the application, and Advanta will submit that request over to the other custodian, the IRA custodian on your behalf. You just let us know exactly the dollar amount that you want to move over. With transfers and direct rollovers, it's no tax liabilities to you. You get to move as much or as little as you want to or need to make your investment. Alex, I'll pass it back over to you.
Fantastic. Thanks, Reneika. So as we alluded to, there's really not necessarily a restriction on the type of investing that you do. And obviously today we're going to be looking at real estate and two of the main different ways that people like to invest in real estate, which are either doing it as a rental project or as a rehab project. But to even drill down that even further, there's not necessarily a metric saying to a certain type of real estate that you have to have. And with over half of our client base being invested in real estate, we like to really drive home the point that really whatever is most attractive to you, or maybe what you understand the best, you feel is the best fit for your retirement plan, will typically work. So we have people investing in single family homes, which are long, short-term rentals. I have clients today that I'm working with specifically right now, a little bit later this afternoon, that are doing Airbnb and VRBO projects up in the Carolinas for vacation rentals. So it's not necessarily something just as, maybe as entrenched that you might think of, a standard 12-month lease. You can do short-term things as well. And it doesn't necessarily have to be a standalone house. It can be things like condos, mobile homes, and mobile home parks can also be extremely lucrative. And then if you want to get into the paper side of things like tax deeds, real estate investment trusts, and syndications are also viable options for you as well when it comes to actually investing in real estate. Now, there are some things that you need to understand. While I said the only two things that you can't invest in with a self-directed IRA are going to be life insurance and collectibles, you do need to understand that there are certain things that you aren't allowed to do. So actions that are prohibited, not necessarily in the investments themselves. So there's certain people you can and can't deal with, and we'll get to that a little bit later with a nice little infographic. But here are some situations, especially with real estate, that we've seen people get into issues with. So if your IRA purchases a piece of real estate, you can't purchase that from your immediate nuclear family, meaning your son, daughter, spouse, or mother or father. So in the case of this, if your IRA purchased a piece of real estate, it couldn't be from your son. I had a client many years ago, back when I used to manage actual investments for clients, that had bought a piece of property in Auburn, Alabama. What's in Auburn, Alabama? It's up at Auburn University. We get a lease agreement afterwards, and we noticed that the lease is written to a young woman with the same last name. We asked the question, who is this person? And it ended up being his daughter. Obviously, his strategy was to buy the house and rent it to his daughter and her friends while they were in school. Although it wasn't necessarily an intent to do something nefarious, it still was a violation of IRS rules. So we helped him kind of facilitate that and get into a position where he wasn't going to be in any type of violation. Something also, as far as debt goes, your father's IRA couldn't lend money to a son. Your IRA purchases real estate and hires your child's company to perform rehab work, and especially important in context of this presentation, as you need to make sure that you're hiring independent third parties to do any type of work to a property. Whether that's a rental or a rehab project, you need to make sure that someone like your mother, father, son, daughter, or your spouse is not going to actually be doing the work for that particular property. And when it comes to talking about real estate, we also have to look at the fact that a lot of times people will look to maybe finance a property purchase. You can certainly do that in an IRA, but you personally couldn't guarantee or personally make a down payment and then collect the remainder from your IRA with regard to actually facilitating that purchase. And then let's say a spouse owns a piece of real estate and wants to sell a portion of that property. You couldn't necessarily sell that to the other party involved in that. You would have to maybe partner from the onset. We certainly do have different webinars that go specifically into partnering and how those types of deal structures can work. All right, now here's the infographic that I had mentioned with regard to who you can't rent and sell to. So it's kind of nicely laid out here for those of you visualizing it. It kind of gives you a good representation of the individuals that are kind of off the table when it comes to either renting, doing rehab work, or really being involved in any capacity with regard to your project. Now that's going to be the IRA owner and their spouse. So anyone that you are legally married to cannot do any work or utilize the property as well as yourself. Any lineal descendants or ascendants of yourself personally. So son, daughter, and grandkids are also within that. A business entity that you own or control by one of the above. So I've had plenty of people ask me, they say, I have an LLC that I own, can that do the work on the property? I'm not directly doing it, but maybe some employees of my contracting company are going to do that. That unfortunately would not be allowable in this context. So if you own the business entity that might want to be used to utilize and do the work, unfortunately you could not do that as well. And there certainly are some other contextual situations that you might get into that would be not allowable. The best thing that you could do is give us a call. You know, we've pretty much seen everything that people have tried to do in the past. We can certainly try to guide you through some of the more detail-oriented portions of how to do work, how to make some of these projects work, and what has worked for our clients in the past. Now, I'm going to turn it over to Reneika for this next portion.
So I think that's still your rehab portion.
Oh, it's still in the rehab. Sorry, I misread that. My apologies. So, yeah. So when it comes to rehabbing and flipping properties, some of the advantages that people look to with regards to these types of investments are, you know, you have less holding time. You know, you're spending less time in one particular project than another, which can definitely be a benefit when it comes to, you know, looking at market forces, which is something, especially with real estate, that can be a very big driving factor in choosing which strategy that you take. Now, obviously, if you're going to be rehabbing, you're going to want to take advantage of market upswings and the appreciable value of the real estate. So that's a really big benefit to doing a rehab, is that you might be able to get into a property and out of a property and then into something else at a much quicker pace. Obviously, the strategy is different with renting, but it's definitely something that drives the factors and the choices that people make in doing a rehab versus a rental. Now, you can get more cash quicker. Obviously, with renting something, you're going to be fixed at a monthly income or whatever the actual, let's say, marketable rate for a short-term rental might be. But with a flip, you might be able to get significantly higher volumes of cash at maybe a slightly quicker pace. You know, for instance, if you're renting a property at $1,000 a month and you're getting $12,000 a year versus maybe putting in your money into buying a rehab property that maybe you put in $30,000, but you make $50,000 of profit in 6 months, that can definitely help to drive the decision-making process. And also is going to depend on, you know, what market you're in and how you're looking to get that cash coming back in. But a great benefit of that, especially in that scenario where maybe you're going to be making a considerable amount of return on your investment instead of doing it personally, where, you know, under a year that's going to be considered ordinary income on those profits. Your IRA is not going to have to pay any taxes on that. So since your IRA is not paying any taxes, it can invest at a much quicker rate without having to escrow any of those payments that are coming in to help pay for a tax bill. And when you're doing the rehab, you get to utilize the people that you know and trust. So let's say you're already in the business of rehabbing properties and you know people that do good work. You can use those contractors that you know and trust in order to do the rehab project. You don't necessarily have to go out and find whole new people, just so long as that they maybe don't work for a company that you own. But you get to use the network of people that you know and trust. You get to invest with the people you know in order to be able to help bolster your retirement plan, which is a huge benefit of doing IRA investing. Is not only are you not paying taxes, but you're still getting the ability to invest with the people that you know and trust in these different scenarios. Now, obviously, everything is not perfect when it comes to rehabs. This is the part of the presentation that I'm focusing on, but it certainly isn't all you know, viewed through rose-colored glasses. We have to look at the downsides and the potential issues that are going on with rehab markets. Prices can fluctuate greatly during a rehab project, whereas if you have a rental, you know, you have a very fixed income with a lease agreement that's going to be coming in. So if during the course of your rehab project, home prices suddenly start to fall or home buying starts to drop off, you know, rather precipitously, like we've seen in the past, then you might be stuck with something that not only costs your IRA a lot of money, but might have additional holding costs, such as property taxes, insurance, and things like that. So if you can't get that property back out and turned around and sold, you know, you're going to have kind of a tough situation to look at. You also have material costs can change. This is especially apparent right now with the COVID-19 related supply chain issues that we're seeing. You know, we saw a huge spike in lumber prices just within the past year and a half with regard to COVID-19. So, you know, you have to look at how much the materials are actually going to cost you, which can fluctuate significantly just over the course of the rehab project. So thinking of things like that, not only is it just, you know, what you budgeted, but that budget might have to go up just for the inherent cost of the raw materials that you're using in the rehab. And obviously that can change depending on the scope of the project, but it is certainly something to look at in regard to that. I see someone has their hand raised. Type in the question to the chat box if you want to get something answered. We will certainly be happy to answer that. And then you have to look at it from the prospect of, you are just essentially spending money during a rehab project, and you don't make a return until that property sells. And if we do have price overruns, they have to be covered by the IRA. One big downside of doing a rehab project is that you as the IRA client cannot float additional rehab costs. If you have a cost overrun, let's say you're redoing a bathroom and a kitchen, and you have significant cost overruns, and maybe you find there's some termite damage in a wall, or you need to move a load-bearing wall or something in order to do your rehab project, and it cost overruns past what the IRA has available to it, you cannot float that cost. You cannot cover the cost for your IRA. So if something like that happens, you need to have a little bit of foresight in the initial project and the scope of work that you want to do to make sure that your IRA can cover any and all of those costs. Because unlike maybe doing something with an LLC or a few different partners, where maybe one partner can cover the rest and then maybe just get paid out at closing or something to the same effect, the IRA cannot do that if you're going to be doing a rehab project. So one thing I tell clients is that, if you're looking at a rehab project and you have $100,000 in your IRA, maybe don't look at the properties that start at 110,000. Maybe start looking at the ones that are 80, 90, 100. So that way, if your projected rehab that you want to spend is 10, you have another 10 or maybe 20 in reserve, just to make sure you don't run into a really sticky situation where you have to try to figure out some way to finance the additional portion of a rehab project. So definitely some big downsides to look at, but there also are some very big upsides with the amount of money that you could potentially make with regard to rehab projects. And then from there, now, I think I turned it over to Reneika. I thought this was your slide.
This is still your slide.
Okay, yeah, expenses paid for by the IRA. So, you have to invoice the IRA. So we will pay any and all expenses. We pay the bill the following business day. You can have a property manager or a project manager. So if you'd like to have those things taken care of by a third party and not necessarily submit them directly to us, you can have a property or a project manager. We're more than happy to accommodate those kind of things. But just understand that you don't necessarily have to have a property manager. We have plenty of clients that typically are a little bit leery of maybe paying 10% on the gross revenues from a property just to have someone write checks and everything. We can certainly accommodate that, but depending on the scope of the rehab projects, people might want to have a property or a project manager. Conversely, you can also utilize things like checkbook control to make things a little bit easier on yourself. You don't necessarily always have to go through us, but we can certainly make sure that the things run as smoothly as possible when it comes to paying the bills, making sure that they're paid in a timely manner. Because the last thing you want to do is have an angry contractor that's going to try to put a lien on your property because you're not getting paid efficiently. If you submit something one day, it is issued and mailed out the following business day. And we also have an online portal for you to directly do any and all of those payments that you need to do as well. So again, who can do the property with regard to rehabs? Who can't do the work? The IRA owner cannot perform any services on the property, including painting, mowing grass, replacing water heater, any repairs or anything that's being done to the property, you cannot do. And who can do the work? Any non-disqualified person. The IRA owner can inspect the work, and however, there are no guidelines as to the qualification of the individual performing the work actually.
Okay, thank you, Alex. I'll take it from here. So the beauty of self-directing, of course, we know is it puts you in control. You have control over the investment decisions. It allows you to invest in what you know, what you understand. So for you, if you're a real estate investor, you've been successful in investing in real estate, or if it's something that's of interest to you, you get to replicate that existing skill set into your retirement account to grow your IRA. Specifically, when we look at rental real estate, we know it's still considered to be one of the best investment vehicles because you have the ability to get those steady returns and higher flow back into your IRA. So there are many different forms of real estate investment. Alex alluded to or mentioned some of the options available to you. When it comes specifically to rentals, cash flow, of course, we know rental property can produce strong cash flow back into your IRA month after month, year after year, compared to some other investments, maybe like, bonds or annuities, depending on, again, how long you keep that property in your IRA. So having a good rental property can be a good option for steady returns to build retirement wealth over time. And then, of course, real estate as a whole is less volatile, but specifically with rentals, it's not typically, it doesn't fluctuate. We know people always need some place to live. So again, having rental real estate is a good option for you. And of course, the tax benefits of, you'll pay taxes on real estate gains outside of your IRA, but in a rental income situation, the funds from that, the income from that is not taxable. So again, having those rental income flow back into your IRA every month without any tax liability is a great way to accumulate wealth. So it's not about how much you make, but rather how much you keep. So with a self-directed account, that tax shelter is tax advantage. I know a lot of real estate investors typically look to have, properties, look for the ability to depreciate properties on an annual basis. Because you're using a tax sheltered account like an IRA, you don't have to worry about the upkeep of tracking depreciation. You just more so focus on building wealth in that tax advantage account. Let's go to the next slide. So again, I'll just highlight some more of the other advantages and benefits to owning real estate in your IRA. Of course, we have portfolio diversification in terms of, rental real estate really allow you to have a balanced portfolio. Again, because real estate is often, moving counter to the traditional financial markets, just holding at least a portion of your IRA in rental real estate is an excellent way to diversify your IRA holdings to kind of reduce the overall portfolio risk. Because there's no major fluctuation with rental markets or pricing, it gives your IRA better diversification, which is a core function of self-directing. And then, of course, again, because people always need a place to live, you typically don't see a significant drop off in rental rates. Rather, it increases over time. And like Alex mentioned, you have the ability to use leverage non-recourse loan if you're looking to purchase real estate. You can do the same if you're looking to buy actual rental properties. So leverage, it allows you to grow your real estate, grow your wealth a lot quicker in an IRA when investing in real estate. You don't have to have all of the funds up front to purchase that rental property. The loan type itself would, again, has to be non-recourse, meaning that you're not going to personally guarantee that loan. The only recourse the lender would have would be to foreclose or take possession if the loan is not repaid. In a rental scenario, you put down a down payment, whether it's 20 or 30%, whatever, based on that lender. And then, of course, as the rental income comes in, it pays whatever the loan for that mortgage or that non-recourse loan would be. Advanta, as the administrator, if you're purchasing it directly in the IRA, would help facilitate in paying those bills, the income, the expense related to having a non-recourse loan. But again, with the rental property, the tenant is actually paying down that loan for you. And then, of course, we look at asset appreciation. So we know real estate has historically appreciated over time. Nothing goes up forever, but we know real estate always holds value, making it an ideal investment for IRAs, especially if you're looking at that longer term approach. So in addition to having good cash flow with the property appreciation over time, it allows your IRA to really participate in the upside and value and growth as you hold that property. And then we know rentals can be very passive and or have lower maintenance in that if you have good systems in place, if you have efficient management in place, like Alex said, you can elect to have a management team oversee that property. Or if you have systems in place for yourself, it allows you to really scale and have multiple rentals. Working with a self-directed administrator like us at Advanta, the accounting and record keeping is made easy for you. So again, if the property is held directly within the IRA, not using checkbook control feature, there's really no need for you to track the rental income or expenses separately because that's our role at Advanta. Will track, allowing you to focus on finding the next property. And your goal is to, again, make sure that your rentals are efficient and profitable, making sure there's more money coming into the IRA than it's actually going out. Okay, while there are many advantages to rental, there's, you also have to be considerate of some of the cons or disadvantages to rental property, specifically in your IRA. So some things to be aware of and factor in is obviously a vacancy or having a bad tenant. If the property is empty, there's no money flowing back into the IRA. The IRA is still responsible for covering, any of the expenses or bills related to that property, especially if you have a loan against using non-recourse loan. Your IRA is still responsible for making those payments. So you want to make sure you keep the property rented. If you're having bad tenants, for instance, if they're not paying or there's extended delays or some issue with rent collection, then of course that affects the overall management of the property. And then with real estate, we know it is harder to liquidate that asset. While real estate is a hot market right now, it still takes time to sell off a property. Another factor to keep in mind when owning rental property in your IRA, specifically a traditional IRA, you are required to take a minimum distribution once you reach the age of 72. So if you own rental properties in that IRA, and if you don't have cash available in any of your IRAs, you may be looking to have to liquidate or take property distribution to satisfy that minimum distribution at 72. Another drawback or a factor to consider, the maintenance, the repairs, the upkeep, the costs associated with upkeeping the property can be very high if you're not budgeting accordingly. If it's an older property or if there's deferred maintenance, in addition to having to do major repairs or those ongoing minor repairs, it can really eat into the profits of your flowing back into your IRA. So you want to make sure you're accounting for the cost of everything. If you have, if you don't have, efficient management in place, it can really compound and be costly for you. If you have multiple properties and you don't have a good system in place, again, those repair costs, it adds up. And like Alex mentioned, for you as the IRA owner, you're not allowed to do any of the sweat equities or any of the repairs. You have to hire it out to a third party, someone who's not considered a disqualified person. And of course, all of the expenses, repair costs are paid out of the IRA. And then finally, there's no personal use of that property. You do have to be mindful of the prohibited transaction that Alex mentioned in terms of the IRA not being on the opposite side of the table from someone who's considered disqualified. So it should be for investment purposes only. You can't live in that property. You can't rent it out to a disqualified person, like the example Alex mentioned with a client that he assisted. So if you don't follow the rules, you do happen to make a prohibited transaction in your IRA, you can possibly jeopardize the entire IRA. In the solo 401k, it's slightly different in terms of the penalty would just more so be specific to that transaction if it's rectified in a timely manner. But if you make a prohibited transaction, meaning you rent it out to your son or your daughter, you can possibly jeopardize, or your entire IRA can cease to be an IRA. When it comes to actually renting out the property, you as the IRA owner actually goes through the process. You want to do your due diligence. You get to screen and qualify the tenant to make sure that they're a viable tenant. Advanta, as the administrator, as the custodian, will actually sign the agreements on behalf of the IRA and also receive any of the income associated with that rental property, and then of course pay any of the actual expenses. In terms of the actual terms, you as the IRA owner get to negotiate those lease terms. You will be listed as the actual point of contact if the tenant has any issue. Again, you can have a property management team in place as long as it's not your company or a disqualified person's company. If you don't elect to have a property management in place, again, the tenant will reach out to you directly to handle any issues that they may have. So I'm going to transition and take a look at a case study in terms of purchasing rental property in your IRA. So in this scenario, we have Paul and Linda. They're looking to partner together on to purchase a rental property in their respective IRA. They both have $100,000. It's their responsibility with self-directing. You find the investment. Advanta, we don't have a list of investments for you to choose from. So it's Paul and Linda's responsibility to go out and find that property. In this case, they went door knocking, working with their local agent. They found a property for $150,000. They decide they have complete autonomy on, the work that needs to get done. As long as they're not doing the work, it's perfectly fine. So in this scenario, they decide, it's going to need $20,000 or so to get it rent ready. They've done their due diligence, they understand the local market, and they're comfortable in that they're going to get $1,500 per month for rent, which will flow back into their IRA. So the process to kind of get this deal going, Paul and Linda will first and foremost open up their accounts with us and fund it. We'll be there to walk them through that step. They will be assigned an account manager once they have an account with us. Again, they'll find a property, they'll put an offer to purchase a property, not in their individual name, but actually in the name of their IRA. So Advanta IRA FBO, which is for benefit of their first and last name and account number. They will work with that assigned account manager to fill out, to complete the purchase authorization. Again, nothing happens until Paul and Linda give their explicit consent, meaning they read and approve all of the documents to have Advanta then work with that closing agent, work with that closing attorney to make sure everything's properly titled. Once Advanta gets consent from Paul and Linda, we'll send the funds to that closing agent to purchase that property. Advanta, as the administrator, as the custodian, actually holds all of the documents, whether it's the title or statements relating to that property. And again, with a rental situation, the tenant's going to send the rental check to Advanta to be deposited into the client's account, Paul and Linda's account. Or if it's a property management, they'll take up their fees and then redirect the balance to Advanta. Anytime money's deposited into a client's account, they'll get an email notification of that and also be able to log into an online portal to view those statements. Some other things to consider in this scenario, because it's both Paul and Linda partnering on the real estate deal, it's going to be partnered title as, the deed is actually going to be title as tenants in common. So in this scenario, it's going to be a 50-50 split, Advanta IRA FBO, which is for benefit of, Paul's IRA number as to 50% interest, and then Linda IRA as the other 50% interest in that property. The percentage is more so based explicitly, on the contributed amount from each IRA. So they'll share in the $1,500 that's coming back, 50-50 split, whatever expenses related to. If they got to pay, a contractor or property taxes, they'll share equally in those expenses. And then, of course, the percentage of ownership is based on, the amount that's put in. So if Paul and Linda were husband and wife, the percentage would have to remain as is, in this case, 50-50.
Great, thanks, Reneika. Turn it over to me for my part on rehab projects. We had some people ask some questions a little while ago. Just want to make sure that those get addressed. I don't think we're forgetting you. We have David asked, is it possible you can refi after you purchase the IRA rehab to get some more money? If you have financed the property and you find another recourse that you're willing to do a refinance to that effect, yeah, you can certainly do that. But keep in mind that when it comes to non-recourse financing, there are, less lenders out there. There might be some more specific terms you need to look at. We're certainly happy to help you try to figure out those specific type of scenarios. But what you indicated with regard to a refinance, certainly there's nothing to say that you're stuck with the financing that you have if you were to finance the property purchase, whether it be for a rehab or a rental. And then Nancy asked, can you put an IRA into an LLC? Absolutely. We've taught several different courses on utilizing what people like to call checkbook control, which is utilizing an IRA-owned LLC, or sometimes people use a trust. Most of the time it's an LLC to invest into a piece of real estate, where the IRA would own the shares of the LLC, and then that LLC would in turn purchase the actual asset. Now, keep in mind that if you're trying to utilize that for asset protection, you would always need to check with an attorney that is familiar with liability law in your state, as it does vary from state to state. So we got 50 different flavors in the US of liability laws when it comes to real estate and things like that. So check with a local attorney that can advise you to that effect. But with that said, let's get into a case study number 2, which is buying a rehab project. So what does that exactly look like from the IRA's point of view? There we go. So in this case, John wants to use some of his old 401k from a previous employer to purchase a rehab property down the street from his house. Now, keep in mind that, as Reneika had said in the very beginning of this, if you want to use a 401k, it either needs to be from an old employer or you need to be over 59 and a half. Because if you're still currently employed with the employer that offered the 401k, you might be restricted from moving money out of it as an in-service rollover if you're not 59 and a half. So if you've terminated employment and it's just an old 401k sitting around, thumbs up, you're good to go. You can use that for buying your rehab project in an IRA. So who does what in this scenario? So John identifies the property. We're not identifying anything like that. He opens the IRA with Advanta. We help facilitate that rollover. He makes the offer to purchase the property. So he negotiates with the seller. They've come to a good price, and then he submits the contract and all of the closing documents to Advanta in order to get signed and properly funded. Now, what Advanta takes care of is working with the closing agents to ensure proper titling on all closing documents. We sign everything on behalf of the IRA, wire funds to close, and then, of course, we hold the property in trust in the IRA for continuity and IRS compliance. And then we receive all the income and pay all of the expenses, which, again, is very important in this. Just like with a rental property, all of the rental income comes back to the IRA. And for a rehab project, all of the expenses are paid from by the IRA. So what exactly is his strategy here? The property that he's looking to purchase is for $120,000. The property needs a new kitchen and 2 new bathrooms, $30,000. So he has enough to cover all of these expenses. Over the next 6 months, all of the work is completed. We at Advanta are going to be paying all of those invoices that he submits, again, within 24 hours of submission. And then after about 6 months, John finds a buyer and sells the property for $180,000. So in this case, he bought it for $120,000, put 30 into it. So now he's sitting at $150,000 of total invested in the property, and sells it for $30,000 profit. Now he has $180,000 to invest in a new project. Now, while this may seem like a very elementary deal and very big round numbers, one of the big benefits to realize from this is that unlike doing this in a normal fashion, let's say personally, if you made $30,000 on a particular project, you wouldn't necessarily want to go and drop that right back into another project because you'd have taxes to pay. So you would never want to be in a situation where you are fully invested and unable to pay taxes after the first of the year because you have to pay taxes on those profits. Now, certainly there are strategies, things like 1031 exchanges and other ways to help mitigate some of those taxable liabilities. But for the most part, you probably are going to be paying some taxes. Unlike with an IRA, immediately upon completion of that project, when the wire hits John's account for $180,000, he can turn around and buy another project for however much of that he wants to use, and continually to compound that interest in the tax-free nature of the IRA without having to worry about escrowing any taxes out. So that's really the big benefit of looking at it like this, is that yes, you're not getting to take advantage of depreciation or amortization to help offset taxes. And a lot of investors, real estate investors particularly, like to utilize those things to help mitigate and reduce their taxes. But with an IRA, it's another way for you to use your retirement to invest in things that you know and understand, instead of just being dropped in the stock markets. While some of the tax benefits that you see personally might go away, the ability to do this and also not pay taxes with your IRA and also use your IRA to invest in things you know and understand is a very, very big benefit.
So in terms of education, Advanta, we're pretty known for providing you great educational content, anything and everything relating to self-directing. We host recurring webinars and obviously seminars and webinars like this. We have a lot of different guest speakers that come in and expert in their field. We also do what's called Pitch Promote Prosper, is our online networking event. It's a virtual investment marketplace. It's an open forum to, open to the public, our clients, obviously investment providers. We don't endorse particular products, but it's more so it gives you the opportunity to introduce yourselves, almost like haves and wants. So it's a great place for you to connect with other real estate investors. We also now have a podcast, the Alternative Investment Advantage podcast, which is actually led by Alex. So definitely encourage you to, check out our podcast, attend our pitch, our networking events, look at our YouTube channel or our video library. It's pretty comprehensive. Anything and everything relating to self-directed is on our website at advantaira.com. Our blog is also, good for the latest industry news and trends as well. When you're ready to get started with us, we've really streamlined that process for you in 3 simple steps. First and foremost, you'll fill out the appropriate application to open up your account. You can do it electronically via DocuSign. You can do it online on our website. We'll be there to guide you through it. You will have an assigned account manager, someone who's going to be there with be there for the life of your account with us. Step 2 is funding the account. And again, you have several ways you can do that. Make an annual cash contribution. You can transfer as much or as little as you want to or need to from your existing IRA, or you can do a direct rollover of those former employer plans that's just sitting idle. And then finally, step 3, what is it that you want to invest in? You really have a blank canvas in terms of, the options available to you. So if real estate is your preferred strategy, whether it's, doing a fix and flip or a rental or a combination of the two, you pretty much are in control. You're in the driver's seat of what works best for your IRA.
Yeah, absolutely. Thanks, Reneika. We're winding this up. If you have any questions, make sure you type those in there. But it's part of our responsibility, I feel, to help educate our clients, not only in the investment options they have, but also what is going on with regards to these fantastic, tax shelters that have been provided to us with regard to IRAs. Now, currently, we are a bit under attack with regard to how people invest with IRAs. There is current legislation that is part of the larger spending bill that is right now being worked out through by the Senate. It's gonna, if it goes through in its current status, it has the ability to immensely affect clients' abilities to invest in alternative assets. Mainly, it would essentially prohibit you from investing into any type of private security. Now, people might think, oh, well, that's just, helping people, preventing billionaires from buying companies that before they go public and things like that. But it's specifically even legislated down to being able to use like an IRA-owned LLC or a trust within your IRA to buy real estate. So it's affecting essentially everyday people's preference on how they actually buy assets and acquire those assets and protect themselves. If you aren't able to utilize partnership LLCs and you want to invest in things that might be more risky with regards to lawsuits, with real estate portfolios, that can certainly be a concern. This legislation would essentially prohibit you from doing that, as well as many other things that it would get rid of, as well as certain parts of Roth conversions. I would also get rid of certain types of Roth contributions to 401k plans. Now, it's certainly something that we are fighting against Advanta IRA. We are currently actively lobbying against these provisions of this bill. We've partnered with some great people. And attorney John Heyer has put together a fantastic website, handsoffmyira.com, which is a great kind of punch list if you like to contact your representatives or senators regarding this legislation to try to get them to pay attention to it, to hopefully get it removed, so that way we can preserve the security of this form of investing. We've also established a change.org petition to help try to drive more attention to these troubling provisions as well. Change.org/save our IRAs. Now, we encourage, again, everyone to get better educated. I've done 2 podcast episodes on the Alternative Investing Advantage podcast, which you can find on any of your podcast platforms, whether it be Apple, Spotify, any of the big ones. You can find that on there or on our website as well. So if you want to get some more information on that, I've done about an hour and a half total of open discussion with attorneys, actually 2 different attorneys, regarding just exactly how this can affect investors with regards to IRAs. So make sure that we educate people not only on the investment options, but also anything that might affect their ability to invest in the way that they see fit, and then also into assets that they know and understand. So with that said, if there are any questions, we'll stick around. We're kind of right up on the end of our presentation. If you want to get in touch with either Reneika or myself, our contact information is right up there. I'm local to our Tampa office down here in the Clearwater area, and Reneika is up in the Atlanta area. So if you are local and want to stop by and have a meeting, we're certainly happy to accommodate that if you're local to either of those areas. Let's see, we have someone that gave some information. There are also some AARG, I'm not sure if that's supposed to be AARP resources regarding contacting legislators about self-directed IRA restrictions. SK put out there, yes, we encourage you to contact your representatives, get on our website, kind of educate yourself more on some of these legislative issues. We can certainly help to try to fight this to preserve this great way of investing. Let's see, SK, are all of the resources free for non-clients of Advanta? Absolutely. We do not charge or have any type of paywall for our education, whether that be our webinars, whether that be any of our in-office stuff that we might be getting back to. Our Pitch, Promote, and Prosper is open to any clients or non-clients. We encourage non-clients to come. Hopefully you can get educated and more and network with other investors, as well as our podcast is free as well. So all of our educational materials and any of our platforms are always free. Reneika, did you want to take Andre's question?
Okay, so question, what age can you take money out and is it tax? So question came in that the retirement age is 59 and a half. So once you reach retirement age 59 and a half, if you have a traditional IRA, that's when you pay taxes. With a Roth account, meaning as long as you've had the account for at least 5 years and you're at the 59 and a half, your distributions will be tax free. Let's see Andrea's question.
Andrea's question was how to unwind a self-directed IRA. Essentially, I mean, there's really not anything per se to unwind. If you have a self-directed IRA, you're certainly allowed to transfer funds back and forth between a more traditional type IRA, like a brokerage IRA, if you'd like to, or if you'd like to roll over to a Roth IRA. If you're talking about converting assets, you know, that's a taxable event. We can kind of go through that, and it may be more of a specific consultation if you want to contact either Reneika or myself to maybe be a little bit more specific and dig into that. Either of us are happy to schedule a consultation. So Andrea, feel free to reach out to us directly because that might need to be a little bit longer of a conversation. Reneika, do you maybe want to answer SK's question on 401ks?
Oh, let's see. So for people that dip into IRA funds or 401k this year and last, is there a more aggressive catch-up plan? So those who dipped into IRA funds or 401k this year and last, there's more aggressive catch-up to replace those funds. So the provision do allow you 3 years to make those, to replace those funds without being subject to any taxes or penalties. So you do have that 3-year window.
Correct, yeah, but with regard to like catch-ups, like maybe specific to like the extra $1,000 you get in IRAs or the bump you get with 401ks, unfortunately, SK, there is not. You just have the ability over the next 3 years to replace those funds as a rollover, and then you would have to refile your subsequent tax returns to show the reduction in any taxable income that you might have paid from taking that distribution in that particular year. So while you can certainly replace it, there's not necessarily a catch-up per se.
So let's see, next question is, as age 55, if you get started, you must have IRA in place for 5 years to cash out with no taxes. Yes, with the Roth IRA, so you have to have it for 5 years and be age 59 and a half. So you would have to at least have it for 5 years if you start, at 55. So when you reach 60, you can take out tax-free with the Roth.
Yeah, and another part of that, David, is that you get credit for the entire year, no matter when you open the account. So if you opened up a Roth account December 31st this year, you get credit for the full year of 2021. So it's not necessarily from a date, it's just the year in which you open it, you get full credit for. So it's something good to know. It doesn't necessarily apply to everyone, but it is nice that the IRS does give you credit for the entirety of the year in which you open that Roth IRA.
And contribute.
Yes. I think we got people kind of dropping off. So maybe, Reneika, if you want to go ahead and button it up there, because I think you are the main administrator of this presentation, we'll go ahead and let everyone get back to their day.
Thank you, Alex. Thank you, everyone, for attending. Again, if you have any questions, don't hesitate to reach out to Alex or myself. And then, of course, visit our website at advantaira.com. Have a good one.
Thanks, Reneika.